for FY24. Let's turn our attention now to Titan. Reported numbers last week, a very good performance in Q2, a beat in the EBITDA and profitability. The revenue jump of 32% is optically higher. That's due to the sale of gold ingots. The watches business crossed the 1,000 crore mark for the first time ever. Ashok Sonthalia, CFO of Titan, is now with us on the show now. Thank you very much for joining in. Sir, can we begin by talking about how demand has been in the month of October? What can we expect in Q3 given the festive season and the wedding season?
We have this time, that the Shraddh period, which was last year in Q2, has shifted to Q3. So first 15 days of October had some of that impact. And that is where it is very difficult to judge the whole quarter from the October performance. But second half of October has started pretty well for us, our jewelry business and some of the other businesses. So we are pretty hopeful that we will have a good Q3. Even on the solid base of last year, Q3, we should be able to deliver some healthy growth numbers.
Okay, so for the second half of the year, what kind of guidance can you provide in terms of, say, the jewelry business revenue? What are we looking at?
So second half is easier than Q3 for us to tell. And I definitely believe that we can do mid-teen to high-teen growth on the second half of this year.
Mid-teen to high-teen. What would margins look like, sir, in H2?
The diamond prices have come off on the large size stones, which are typically 1 carat and above. And if you look at Tanishq and CaratLane diamond business, and for that matter, Mia also, bulk of the business is on the smaller diamond. We do have some large diamond business in Tanishq, where the corrections have happened, and we would also do a little bit correction on our prices. But that is not material enough to kind of call that out, that what could be of impact it can happen, and still it is unfolding. And like earlier, quarters, we have stated that annually 12 to 13% EBIT margin for jewelry business on a standalone Tanishq business, and we are still very confident that we will deliver within that for the full year.
So what's the outlook on margins? Is there a possibility that margin upside can be capped given the strong competitive intensity in the industry?
Yes, you are right that margin expansion in jewelry business is not going to be easy. Competitive intensity is high and everybody is expanding, national players, regional players, local players. And our focus always has been to kind of growth, number one, and at a sustainable margin basis, sustainable and consistent margin basis. And that is where that 12 to 13%. We are more interested in gaining market share, gaining more customers, and which we are very successful. If you track in last 3-4 quarters, we have been talking about our new customer, repeat customer ratio is around 48 to 52, 47 to 53 sometime. And this quarter, the Q2, which we just concluded, the growth has come equally from the ticket size as well as the buyer growth. So we are able to gain market share consistently. So that's the strategy, keep gaining market share and deliver a consistent margin.
So, there is a big change happening in the diamond market now, right? I mean, suddenly lab-grown diamonds are all over the place. And do you think that could impact the overall demand for diamond jewelry? And how are you preparing for that?
In India right now, lab-grown diamonds are not at all impacting demand. Consumers are still not asking for that. But if you look at the US market, which is always, in a way, a few years ahead as far as diamond jewelry is concerned, there the bridal segment, which is 40% of diamond jewelry market in US, out of 40%, yes, we are also hearing and getting the signal, 40 to 50% of the center stones are getting replaced by lab-grown diamond because people are able to afford higher size of lab-grown diamond in lesser price than, on a smaller stone, 1 carat, 2 carat of natural diamond. So that shift is happening. We are keeping an eye on all these developments. We have a minority stake in a lab-grown diamond jewelry company in US, and purpose of that stake, which we did 2 years back, to 2.5 years back, 2 years back, I think, was this only, that we can keep a close eye on the lab-grown diamond market development.
So what is the guidance on other verticals, watches, wearables, ethnic wear?
So watches business, of course, is doing extremely well, and within that, wearable is really exploding. India has become the largest global market for wearables in terms of number of units, even ahead of China and US. And we are playing our game nicely in that, and we will try to keep maintaining our differentiation in the segments where we are playing. Even on the analog side, on the premium side, we are seeing very, very healthy growth, which is the Helios, our international brand, Channel, and Titan brand. They are doing extremely well. And we are also taking some concrete step on further premiumization or further premium offering coming from House of Titan. So we are very, very positive about the overall watches and wearable segment. The other smaller businesses currently, they have only growth targets and growth support, coming in from our side. They are just focusing on their growth. Taneira is shaping up very well, very, very a brand which is being kind of loved by early consumers who have so far come and experienced that brand. We are trying to create a unique proposition again, the way we did in jewelry, where the weaver salas for the bunkers and pure natural fiber, handcrafted. That's the offering under Taneira, and it's taking good shape. Of course, Eyecare is profitable, doing well. We would like it to grow much faster. Last quarter, it was 12%, and some of those things are being thought about by the business teams, that how can they accelerate their growth trajectory.
So what's the long-term outlook or the strategy for the eyewear business? And are you facing the heat or increased competition from larger players like Lenskart?
So in eye care, while opportunity is large, but yes, you are right. In a way, there are two national players, and the other player is, of course, growing faster than us. Their appeal to the youth and fashion seems to be higher than us, and we need to think about that. More serious specs buyer, I think, prefer us because of the quality of lenses and the craftsmanship of the what we do, our optometry. We are very serious about that because we believe this is an eye care business. Fashion is given. So we are working on some of those stuff. We launched that fast track channel, which was more targeted towards youth. Early days, only 5 stores are piloting, and we are kind of looking at that, what we can do. So you will find some of the new offerings also coming from Titan Eye Care stable to kind of not only improve our competitive position, but grow faster.
And what is the expected growth that we're looking at for CaratLane this year? What is the profitability like, and what does the balance sheet look like post the debt raising?
CaratLane have so far in the year grown 45-46%. I believe definitely for the full year that number is possible, and even they can inch up slightly going towards the remaining H2 closer to 48, 49 or towards 50%, but it's very difficult. But 45-46% is the run rate currently. In the first half of the year, their EBIT operating profit margin was single digit on the lower side, 4-5%, which they have, I think, opportunity to further expand. It will take 2-3 quarters. In any growth company which is more digital oriented, and performance marketing, digital marketing are slightly expensive because of various features. So they are kind of readjusting some of these levers, and even the diamond sourcing, some of the help coming from Titan on that, etc., will help them improve their EBIT margin. And it's a long-term margin expansion and growth story. It is just not next quarter or 2-3 quarters. We believe this opportunity exists for 5, 7, 10 years for them to kind of keep improving some of these parameters. As far as borrowings are concerned, we very, very successfully completed a non-convertible debenture of 2,500 crore at 7.74% interest. While on 30th September you find working capital borrowing was 4,000 crore, but that will gradually come down. Festive season, a lot of good cash collection happens. I would imagine that December end, we should be, including NCD, we should be 3,000, 3,500 crore. And that's the level until unless we do something else, I expect to remain for some time.
Okay, thanks a lot for that and all the best for the quarters to come. Let's slip into a quick break. On the other side, we'll be joined by Kaleeswara N. Arunachalam, who's the CFO of Crompton Greaves Consumer Electricals, to discuss their performance for the quarter gone by. Stay tuned.